All right, let's jump right in. We are going back in time today, but not just to look at some dusty old document. We are here to uncover a genuine treasure map. This is Warren Buffett's 1977 letter to shareholders, and it's an absolute masterclass in business and investing, written way before most of the world even knew his name.
And this quote right here? This is the core idea, the central mystery we're going to unpack. What on earth did he mean by tailwinds versus headwinds? Believe it or not, this one sentence from decades ago explains so much of how Berkshire Hathaway became the giant it is today.
So, that's what this is all about. We're going on a little journey to discover the fundamental building blocks that Buffett put in place when he was just starting to build his empire. And the amazing part is, these lessons are just as powerful now as they were back then.
Okay, first things first. To really get inside Buffett's head, you have to understand how he keeps score. Because it's not the way most companies did it back then, and frankly, it's not how a lot of them do it even now. It all comes down to measuring what actually matters. You see, the standard thinking in the 70s was pretty simple. It was all about earnings per share, or EPS. If your EPS went up every year, you were a hero. The financial news would sing your praises and everyone would pat themselves on the back. It was like the ultimate report card for a CEO.
But Buffett, he saw right through this. He had this brilliant analogy. He said, look, if a company just keeps some of its profits instead of paying them all out, its pile of money, its asset base, is going to get bigger. So, of course, its earnings will go up. It's just like a savings account earning interest. It doesn't mean the manager is a genius.
So he basically tossed that whole idea out. For him, the real test, the true measure of a manager's performance, was something different: return on equity.
So what the heck is return on equity? Well, put simply, it asks a really smart question. For every single dollar that the shareholders have invested in this company, how many cents of profit is the management team able to squeeze out of it? See, it's not about just getting bigger, it's about getting more efficient. It's about skill.
And the proof was right there in the numbers. In 1977, Berkshire Hathaway's ROE was a whopping 19%. Now, that wasn't just good, it was fantastic. It completely blew away what the average American company was doing. This one number showed that his philosophy was working. He wasn't just growing the savings account, he was compounding it with real skill.
And this leads us to the absolute heart of the letter. This is where that whole idea of tailwinds and headwinds really comes to life, because he tells a story of two totally different businesses that he owned. First, let's talk about the headwind. You have to remember, Berkshire Hathaway actually started as a textile company. And even with what Buffett called strenuous efforts from really good managers, the business was a total slog. It was an uphill battle every single day. The entire industry was just so tough that no matter how hard they worked, the results were just meh. They were running straight into a hurricane.
But then there was the tailwind, and this was their insurance business. It was the complete opposite. The industry was so healthy and the business was structured so well that it was just soaring. It was being pushed forward by this incredible, powerful wind at its back.
I mean, just look at this. In a single decade, their insurance business grew its volume by nearly 600%. That right there, that's what a tailwind looks like on paper. It's this unstoppable momentum.
And here was Buffett's big light bulb moment. A great business, a business with a tailwind, is so powerful that it can actually cover up for a few mistakes you make along the way. In the textile business, every single decision had to be perfect just to stay afloat. But in insurance, they could mess up here and there and still come out looking like geniuses. It's much better to be in a great business than to be a great manager in a terrible business.
Okay, so that's how he looked at the companies he already owned. But how did he take this tailwind idea and apply it to the stock market? Well, that brings us to his 4 simple, timeless rules for investing.
First, and this is so important, you have to get this mindset shift. And once you have that mindset, he lays out this incredibly simple but profound checklist. Number 1, can I actually understand what this business does? Number 2, does it have a tailwind? You know, what he calls favorable long-term prospects. 3, is it run by people who are both smart and honest? And finally, number 4, is the price right? Can I buy it at a bargain? That's it. That's the whole game.
And you can see this logic in the companies he owned. Newspapers, advertising agencies, a candy company. These were all businesses a person could wrap their head around. They all had powerful brands and competitive advantages, their own little tailwinds. And they were all run by top-notch managers.
Now this quote about Capital Cities stock, wow,
It is just fascinating, and honestly, it's pretty radical. He's saying that the managers of that company were so good that Berkshire would get a better result by just owning a piece of the company and staying out of their way instead of buying the whole thing and trying to run it themselves. It's this incredible lesson in humility and in trusting great people.
All right, let's bring it all home. What are the big, enduring takeaways from this amazing playbook from 1977 that we can literally go out and use today?
It really boils down to this. First, measure what matters. Focus on return on equity to see how skilled the leadership really is. Second, pick your playground carefully. It's way easier to ride a tailwind than to fight a headwind. Third, always think like an owner, not a gambler. You're buying a business, not a lottery ticket. And finally, recognize that great managers are gold, and sometimes the smartest thing you can do is invest in them and then just get out of the way.
And so I'll leave you with this final thought. In today's world, with all the crazy metrics, the high-speed trading, and the focus on the next 5 minutes, which of these simple, powerful lessons from 1977 do you think has been the most forgotten? It's something to really think about.